Hello and welcome to MasterChartsTrading.com market recap for the week ending Friday, February 6, 2015. This week, a buy signal was generated on stocks, on various stock indices, and small caps seem to be leading the market higher. The market breadth points to a bullish resolution in this choppy range that we've been having for the past few weeks. Bonds also came under significant selling pressure, but the uptrend in bonds still remains. Gold miners and gold itself seem to be rolling over here, and we will examine the targets to the downside, and also we will look at oil and the apparent bear trap in oil. I'll explain what I mean by that. And of course, oil rebound is helping oil-related stocks as well. All right, so let's look at S&P 500 large cap index, shown the chart in the past. Overall, again, a long-term uptrend still remains, and it's been in place since at least 2012, possibly earlier, definitely early 2009, but there were some up and downs there as well, major ones. But overall, the uptrend is up, and we had several buying opportunities. The last previous two buying opportunities didn't work out too well because of the volatility, and then just yesterday on February 5th we re-entered the market, the S&P 500. So last week I mentioned that we did open a short right there on January 30th, but clearly didn't work out, and the support did not break, so support held here. So we covered the short and went long on February 5th. And let's look at the Russell 2000. Russell 2000 seems to be outperforming the general S&P 500 because it had an earlier signal on February 3rd right there. So, it's up about a little bit less than 1%, but this is a good sign for the general market when the small caps are outperforming the large caps because of the appetite for risk. So hopefully it will resolve to the upside, and I think it will, and I'll explain why in the next few charts. So we'll look at market breadth in the next few charts. So this is same thing, S&P 500 large cap index. Let me just disable rollover. So last week I showed that this 20-day exponential moving average rolled over and fell below the 50-day exponential moving average, but this week it just came right back up. So last week the market breadth looked kind of, it looked like it was deteriorating. You can see that percentage of stocks above the 50-day exponential moving average fell below 50%. It was like around 39, I believe, here. And also the bullish percent index was below its 20-day EMA and was dropping, and so was the advanced decline line. But we basically had what's called a breadth thrust again, where a lot of stocks within the index move higher in tandem, in unison. So looks like the percentage of stocks above the 50-day moving average came right back up, and it now is at let me see, 66%. So that's pretty good. That's really good, actually. And the same goes for bullish percent index. It's yet again above its 20-day exponential moving average, and also way above the 50% bullish line. And of course, the same thing goes for New York. New highs, new lows indicator for the New York Stock Exchange. It actually never even dropped below into the negative territory here. So there were some concerns, but they were clearly resolved to the upside. Let's look at the next chart, and this is also S&P 500 large cap index, but it just has a, let me just disable this again. It has a different moving averages. Like, for example, this is a 10, 50, and 200. But this is a simple moving average. In the previous slide, I showed this exponential. And simple moving average, the 50-day simple moving average is important because many traders simply buy above the 50-day moving average and sell below. And you can see that we had quite a bit of chopping around here, going up and down, above and below the 50. So I think, here we have 2 days close above the 50-day moving average, so that's a good sign. I mean, today was not a particularly strong day, but it wasn't particularly weak day either. Also, on this chart, you can see price momentum oscillator on, crossing its signal line and going to the upside. So that's a positive sign as well. And it's also in a positive territory, so that's good. And it's not overbought. So there is a significant possibility we could see new highs because, like for example here, it was already in the positive territory, crossed over, but we didn't really see any major new highs. But here we're not terribly overbought, we crossed over, so I think we have a good shot of new highs. And looking at market breadths, this is a McClellan oscillator derivative, ITBM and ITVM. You can see that they have resolved. Like for example, here I mentioned that it came up above its 20-day exponential moving average, but then dropped right below it. So that was not a good sign, and that's the reason why I went short right there. But you can see that we held support, no problem there, and also closed back above the 10-day exponential moving average in this indicator, and now we're actually in the positive territory. So same goes for the volume indicator as well. So it looks like, the market breadth within the S&P 500 at the very least is pointing higher. So we're very close to the all-time highs again. So I'm counting that we're gonna see some new all-time highs soon again. And let me just show you one more chart for the market breadth, as it's also market breadth chart. So New York Stock Exchange Composite Index, and this is what's called a bullish divergence within the New York Stock Exchange. So as you can see, the New York Stock Exchange Composite is making lower highs. So it's kind of trending down, and then at the same time, the New York Stock Exchange Advanced Decline Line is making higher highs. So you can see this is a bullish divergence, and same goes for the volume as well. And the New York Stock Exchange Advanced Decline Line made an all-time high just, I believe, the day before, just I believe yesterday, and this means that the number of stocks within the New York Stock Exchange is making, is pushing higher. But you can see the volume, which is provided by, large cap stocks, has not yet made an all-time high here. It made it right there. So I think that once the volume catches up, we will see new all-time highs in New York Stock Exchange Composite Line. All right, let's look at bonds. So this is TLT Treasury, Barclay 20+ year Treasury Bond Fund, and I showed this chart in the past. This is a bullish chart. Prices moving from the lower left to the upper right. Within it, per our system, we had several buying opportunities, which all of them resulted in profits. And the final one here resulted in around, I believe, 6% or so profit. So, this is a very strong uptrend in the Treasury bond market. The sell signal was generated just on February 5th, right there, as the bonds came under pretty significant selling pressure, and from all-time high until today and Friday lost over 5%. So, once again, you can see that it's already oversold. So, like for example, here it was already oversold and then just came right back up. Here it didn't even get oversold, but so this could be a nice buying opportunity once the uptrend resumes again. And this is what I'm trying to say is that this may or may not be the top, but until it stops working, I will treat this as a buying opportunity within a bigger uptrend. So we'll see once it stops falling, like for example here it rolled back up, and then the rune surged to 100, and that was a good buying opportunity right there. So same thing, I'm waiting for this same thing to happen. All right, let's examine gold. And so last week I mentioned that gold has been it hit resistance in this resistance zone. Let me just turn this off again. For example, you know, in the $1,300 area, it hit resistance. So since then, basically, gold has traded down in this channel, and then today it broke support by, you know, dumping 2.5%. And there are several issues here. So number one, support is right here. Number two, this 200-day moving average, exponential moving average, broke that as well. Number three, this support level from June of last year, it closed below the June of last year support level right there. And number four is this 50-day exponential moving average. It also closed below it as well. So there was a lot of support breaks just in one day, for that matter. And also the price momentum oscillator rolled over to the downside. So this is not looking good for gold. And, you know, I'm sure next week we'll probably see something like maybe a rising wedge or like a bear flag of sorts, possibly. You know, it's really difficult to predict, of course, what's going to happen, but this is not looking good right there to me. And once again, I'm long-term bearish gold, so this is a good place to go short. And on the next chart, I'll show you what our system did. In fact, our system did in fact generate a short signal right there, just today on February 6th, but sometime during the morning hours. So there was time to get in. So, you know, it was this long that started around January 6th. It was like a valiant attempt, and I did actually go long here, and you know there was about 5 to 6%, sometimes maybe even 7% profit. But I covered everything here, and I'll show you on the next chart why I went ahead and opened a position in DUST, DUST, which is a inverse of gold miners ETF, 3 times inverse gold miners ETF. So this is just the same thing. So what I want to show here is that, you know, we had a counter trend bounce in January 6th, but not yet a short signal in GDX, market vectors gold miners. We didn't yet have a short signal, but I think in the next chart I'll show you what I mean when I say that gold and gold miners are like very, you know, like brother and sister, sort of. So first, let me show you what I mean by that. Is that this is a correlation coefficient between gold and gold miners, and you can see it is extremely positive. Occasionally, it dips into negative territory, but most of the time, it's positive. And this is it makes sense because gold miners mine gold. Let me just update this chart. See, okay, so several issues here. Number one, gold miners on a long-term downtrend, as I mentioned in the past. This green line right there, this is a 200-day moving average, and you can see like how here gold miners have closed above this 200-day moving average for one day and then closed right below it. Another attempt closed above it and then closed right below it. And then again, you can kind of see it better right there at the zoom level. Just yesterday, let me see, yeah, just yesterday it closed above it again, but today it gapped down, kind of rebounded a little bit, and then just continued lower, and it closed at the lows of the day. So this is not very good looking candle right there. It looks quite bearish. And this is the third time it failed to hold the 200-day moving average for more than just one day. It just comes up and then sells off, comes up and then sells off. Same thing, comes up, sells off. So it gapped down, and closed more than 5% down. Some of the features of this chart, you can see that this is a Fibonacci retracement. This red lines right there, and it started advance sometime in November, and I'm counting this January high as the high for this particular advance, and this retrace to 38%. That's a very normal kind of retrace. So I'm targeting at the very least a $20, 60 cents retrace for the how far it will fall. But more likely it will go even further to like 50% retracement around here. But once again, this is a bearish long-term chart, so it's entirely possible that we may see not just a retrace but a collapse even lower. So we may actually see even new all-time highs, all-time lows rather, especially if this support right there breaks down. And from this candle, it looks like Monday or Tuesday it just might, it might just break down. So I went short gold miners by purchasing an inverse ETF called Dust, and I purchased it sometime in the morning right there. As far as the market breadth, the advanced decline line, yeah, it's looking okay. It's looking okay, but I actually don't have a number from today. This is still a February 5th number, so I wonder where it would be. My guess it will be like somewhere here, so it will be already below its 20-day exponential moving average. Gold miners bullish percent index rolled over to the downside, so less gold miners within the index are on a point and figure buy signal. And same thing here, the new highs, new lows indicator, it did go up a little bit. It was at like at 6% or so, but already on the 5th it was at 0, and I'm guessing today we may see it negative on the 6th. I just haven't seen the number yet. It's too early while I'm recording this. So and also look, it's quite a high volume distribution. Quite a bit of selling went on today. So I'm expecting at the very least a retrace of the gold miners to this area and possibly even lower. All right, so let's look at a couple more charts real quickly. So XLU Utilities Select Sector SPDR Fund. I just want to highlight it because today the selling in bonds was pretty significant, and XLU is kind of like a rate sensitive sector. So our entry point was on October 7th of last year, and well, I wasn't actually playing it, but our system generated a buy signal October 7th of last year, and to this date it would have been around 14%, 15% profit. So it's pretty profitable. It was a pretty profitable trade. Now real quickly, let's look at oil. So light crude oil, West Texas Intermediate, I showed this chart in the past. So we had the bear flag or bear pennant breakdown right there. But then you can see there's this hammer-like candlestick right there, and then another hammer-like candlestick right there. And basically it held support. So this area right there of like 43, 46 area looks like it's a good support for oil now, and then it rebounded. And next chart I'll show also our trading system generated a buy signal as early as February 2nd, and it's up about 6% or so to date. I'm not playing this because once again it's a oil is in a long-term downtrend, so there will be probably quite a bit of kind of like sideways action first before we see any kind of meaningful rally to the upside. And so this is also United States Oil Fund, and I showed the chart in the past. There were multiple breakdowns, but this one didn't really work. So there was a breakdown and came right back up. So this is what I think is a bear trap. It came back up, held support right there on a retest, and then it continued higher. So it looks okay, you know, like looks like it might kind of bounce sideways and maybe even go higher. I'm not a big fan of playing these kind of rebounds because this is a long-term downtrend for a security. Nevertheless, since oil is rebounding, with it rebounding the oil stocks as well. And let me show you an oil stock, Chevron, so CVX, and you know, just like in January 12th, there was a short signal because it's in a longer term downtrend since October. So it would make sense to short the rallies versus buying the dips. But now that oil is rebounding, this, you know, if you're interested in kind of like value picking or possibly in like, I don't know, it's called bottom picking or something, this could be a nice opportunity to partake in this oil rally, counter trend oil rally. And this CVX is in a downtrend, so this entry would be a counter trend entry. All right, so just wanted to show you how to find us on the web. So the best things to do is to go to MasterChartsTrading.com. We have a blog. I post all of this videos there. I also have a video section which where I post this video in the future. If you have a any kind of questions, you can send me an email and I usually answer them. Please sign up for our mailing list, and because in the future we will most likely have a trading service that we're about to start. If you have, you can follow, most of these charts are located here on the public charts page. And if you have any Twitter, Facebook, YouTube, or StockTwits accounts, you can follow us there as well. All right, so thanks for watching, and have another great trading week. Bye-bye.